Okay, this video we're going to go through our test 3 review exercises. So I started it up here already, but I'll walk through it real quick here. So the first one is exercise 720, and we're recording the journal entries on honoring a note, and then exercise 21 will be dishonoring a note. So we have on November 1st, they accepted a 6,180 day 8% note from Kelly White in granting a time extension on a past due receivable. So the receivable is getting, sorry, these are wrong. The accounts receivable is going to be credited, and we are going to put that into a notes receivable. So we're giving them more time and we're able to charge them interest. Then at the end of the year, we want to accrue that interest. So I came over here and I used my interest equals principal times rate times time formula. So it's $6,000 times 8%. And then again, the days were all of November and all of December. So there's 30 days in November, 31 days in December. So that's going to be 61 total days that we are accruing. And then always divide it by 360 because it's bankers or ordinary interest. So this is going to be money coming into us. So we are going to debit a interest receivable, and we are earning the interest. So it's going to be a credit to interest revenue. Then they're going to end up paying us on the due date. So we would debit cash. We are going to then credit our notes receivable. We are going to credit the interest receivable. Oops, I didn't spell receivable right up there. And then we're going to credit interest revenue. So again, I'm going to come over here though and do my total formula. So it's interest equals principal times rate times time. And then now in this case, I'm going to do the whole thing. So that's going to be the $6,000 times the 0.08 times 180 over 360. And that gives us, I'll actually, I think I'll do it just right down here below, let Excel calculate it. So 6,000 times 0.08 times 180 divided by 360 gives us $240. Now that's going to be split though. Now the cash is all going to come in, $6,240. The notes receivable is going to be credited at $6,000. It's these two that are going to split the $240. So we've already accrued the $81.33 at the end of the year. So the remaining interest revenue is going to be, what's the difference? So the 240 minus the 81.33 that I already recorded. So that would be our entry there. Then we'll come down to the dishonoring of the note down below. So prepare the journal entries to record the following transactions of the Ridge Company. So on March 21st, they accepted a $9,500 180-day 8% note from Tamara Jackson in granting a time extension on a past due receivable. So same thing we did up here. We're going to debit the notes receivable for the $9,500, and then we're going to credit the accounts receivable again because we accepted the note and giving her longer to pay. Then on September 17th, she dishonors the note. So I'm going to come back over here again using my interest equals principal times rate times time formula and calculate the total interest. So 9,500 times 8% times 180 divided by 360. So that's going to be my formula. And again, I'll go over here and let Excel compute it for me. So 9,500 times 0.08 times 180 divided by 360, and it's $380. So I'm going to put it back into accounts receivable when I find out that she is not paying, but it's going to be the 9,500 plus the 380 that goes back in there. And then I'm going to take it out of the notes receivable $9,500, and then I'm going to credit the interest revenue for the $380. And then December 31st, after trying to collect several times, we decide to write it off against the allowance for doubtful accounts. So we will debit the allowance for doubtful accounts for the $9,880, and then we will credit the accounts receivable. So we always write it off. It's always in accounts receivable when we write it off. So we're going to transfer it back in there. Okay, so those are those two exercises. Then we have this problem. I'm not going to do all of these journal entries because again they do a few too many of the credit cards. We'll just do basically probably just one of those just so you can see that worked out. So on August 4th, we sold $3,700 of merchandise on credit that had a cost of $2,000. So it's going to debit accounts receivable for this $3,700, and then we're going to credit sales for $3,700. Then don't forget we have the second entry where we debit cost of goods sold for the cost, which is $2,000, and then we credit merchandise inventory, which is $2,000. So that's our regular sales entry. Again, hopefully just review of that one. Okay, then we get into the credit card ones though. So on August 10th, we sold $5,200 of merchandise that cost $2,800 to customers who used their Commerce Bank credit cards, and Commerce charges a 3% fee. So the cash is going to come in. We're going to have a new account called credit card expense that we debit, and then we're going to credit the sales. I always start with the sales because that's the one that's given to us. So $5,200 is the sales. Now the $5,200 is what we're going to pay that 3% fee on. So now if I come up to credit card expense and I put in my formula, it's 5,200 times the 0.03. So that's how much we're paying when they use that credit card. And then our cash is the difference, 5,200 minus 156. So that's how we would always do the credit cards. Always start with your sales. We know what that gross is. Calculate your credit card expense by multiplying it by the fee. And then the cash is always the gross sales amount less the fee. All right, so then I'm going to skip then down. Oh, sorry, got to do the cost of goods sold. So the cost of goods sold is $2,800, and then we'll take that out of our merchandise inventory. And then I'm going to skip then down to the 14th. So the 14th, we received the carpenter's check in full, which is up there, that top one we did on August 4th. So the cash comes in at the $3,700 that they owe us, and then we credit accounts receivable. Okay, and again, I'm going to skip because the credit cards will be the exact same as what we did on the 10th. Then on the 22nd, let me go down. Then we wrote off an account of Craw Company against our allowance for doubtful accounts. The $498 balance in the Craw Company's account was a credit sale from last year. So we don't care when it was from. Now that we realize it's going to be not going to be paid, we're going to debit the allowance for doubtful accounts for the full amount. And and then we're going to credit the accounts receivable for the $498. Okay. Then we go down to problem 2B, where we are estimating our bad debt. So I think I'll just kind of come over here to the side. So we have number 1, prepare the adjusting entry to record the bad debts under each of the following situations. Let me see if I can just shrink that in just a little bit. Okay. So again, all of these, if we're doing our bad debt, they're all going to be at year end. So that will be our date that we would do it. I'll come over, I guess, to the side here. If we're assuming it's 2.5% of our credit sales, we are going to take our credit sales of 1,342,000 and then multiply that by the 0.025. So then I'll put it in here. We're going to debit bad debt expense. And then we're going to credit the allowance for doubtful accounts. It's going to be big. I see I made another spelling mistake up here. Okay. But then I'll go ahead and let Excel do the math of it. So equals 1,342,000 times 0.025, and that gives us 33,550. Okay, then it says now, what if it's 1.5% of our total sales? So it's going to be the same accounts as above. So I think I'll just copy these and carry those down. But then we'll do the math over here a little bit different. So it would be the cash sales plus the credit sales. And then we'll multiply that times the 0.015. So that's our mathematics. I'll go ahead and let the Excel do it though. So 1025 plus 1342 and then times 0.015. So then that's going to be $35,505 that then we would charge off to bad debt expense if we were doing it on our total sales. Then C says an aging analysis estimates that 6% of the year-end accounts receivable are uncollectible. And as we look up in the box, it tells us accounts receivable is $575,000. So again, we're still using the same accounts. So I'm going to copy those. Oops, come up here. Copy those and then paste them down in there. All that's going to change is how we compute it. So when I come over here, then I'm going to say, okay, my accounts receivable, 575,000 times the 0.6%. But then I have to compare that to what's in the allowance for doubtful accounts right now. So the allowance for doubtful accounts right now is 7,500. So it's a credit balance. So again, remember credit, we're going to subtract. If it were a debit, we would add. So then our journal entry is going to be for $27,000 as our debit to bad debt expense, and then our credit for allowance for doubtful accounts. So again, you calculate the percentage times the accounts receivable, compare that to what's currently in the allowance. If it's a credit balance, you subtract them. If it would be a debit balance, we would have added those, and that gets our bad debt expense. Okay, then number 2 says, show how the accounts receivable and the allowance for doubtful accounts would appear on the December 31st balance sheet if we were using 1A. So that was this first one up here. So we would have accounts receivable at the 575,000 that's on our balance sheet, and then we would subtract that allowance account. I'm going to just abbreviated allowance, but it would be the whole thing. And then that is 33,550. So then we would net those, and that would be our accounts receivable net. And then what if we did it as of 1C, which is the last one we did up there. So again, I'm going to copy these down. And the 575,000 is still the accounts receivable, but now our allowance, we wanted it to end at 34,500. So that is what that allowance would be, and then the net would be 540,500. Okay, so again, those are 2 of our different methods, as a percent of sales or a percent of accounts receivable. Then our third method was down here in problem 7, 3B. So this gets into a little more detail, and it factors in the aging of the accounts receivable. So we've got our not yet due, the 396,400, and those we're estimating them to be at 2%. 277,800, we're estimating those to be at 4%. 48,000, we are estimating to be at 8.5%. 6,600, again, 61 to 90 days past due, we're estimating those to be 39% uncollectible. And then finally, the over 90-day ones, we're going to estimate those to be 82%. So then I'm going to let Excel do the work, but you take each one, multiply it by the percent, and then I'm going to just copy that formula down. And then we will sum those all up. So then that is going to be the total that we want to have in our allowance account. Now, as we look at it, it tells us that our allowance for doubtful account has an unadjusted debit balance of 3,400. So if it's a debit balance, we're going to have to add those. So then what we want it to be plus that debit balance, again, remember that is more like an error that we would have had at the end of last year that we didn't quite accrue enough. So our, so our journal entry, again, at the end of the year, we are going to debit bad debt expense. And then we're going to credit the allowance for doubtful accounts. And it is going to be a debit of 31,390 to the bad debt expense, and then 31,390 credit to the allowance for doubtful accounts. So again, it just puts it into a little bit more detail. So that is our Chapter 7 review. Then we get into our Chapter 8. And we have disposal of assets, depletion, a balance sheet, the asset turnover. I might start down here because this is our basic methods. So we've got our straight line depreciation, our units of production, and our double declining balance. So the Manning Company installs a new machine costing $324,000. with a 5-year life and an estimated $30,000 salvage value. So if we're doing our straight line, we've got the $324,000. We have a salvage value of $30,000, and then we have it going over 5 years. So mathematically, that formula is going to be that cost minus the salvage value, and then we'll put that in no, okay. We'll put those in parentheses, and then we will divide it by the service life. So that's going to be how much we would depreciate it each year if we were using the straight line method. Our units of production, it's the same basic thing here at the top. So our cost is $324,000. Our salvage value is $30,000. But then now, instead of dividing it by the years, we're going to divide it by the units. So 1,470,000 units. And then again, we'll come over to that formula. I'll put in my parentheses first, though. So that minus that, and then divided by that. So then it's going to be 20 cents a unit. So then we'll come down to year one. And year one, it tells us that there are 355,600 units. In year two, there is 320,400 units. In year three, there is 317,000 units. In year four, $343,600, and then in year 5, $138,000. Whoops, sorry. And then I'm going to just add those up to make sure. Oh, no. So it does say it exceeds it, right? So then that's going to be the thing here. So we want to take year 5 away, and we want to say, okay, it cannot exceed this. So that minus year 1, minus year 2, minus year 3, and then minus year 4. See what's left. So 133,400 units are left. And again, what I was trying to do was to get to the total units that they expected, which is that number there. So then we know we're good. Now we're going to take each one and we're going to multiply it by the 0.20 cents, or the 20 cents, 0.2. So then we'll take quantity times that 20 cents, and that's going to be our total depreciation for all 3 of those years. Okay, then our final method is our double declining. And then that we're going to start with our balance of the 324,000. And then we are going to say, okay, for year 1, our straight line method is 1 divided by 5. So then our double declining is going to be that times 2. So then we're going to take the 324,000. Well, actually, I can just go like this. I'm going to say we're going to take that number times that rate, the double declining rate, and that's going to be how much depreciation it is. And then I'll put in a column for my accumulated depreciation, and then I'll put in my book value. So that minus that gives me my book value. Then year 2, it's going to be my book value, which is now the 194,400 times the 0.4, and that's how much is being depreciated. And then my accumulated depreciation is what it was last year plus what it is this year. And then my book value is that minus the accumulated depreciation. Or you could take the 194 minus the year 2. Okay, then year 3, it's going to be that book value times the double declining rate. And then that we're going to add that to our accumulated depreciation. And then we are going to subtract that from and we'll take that book value times the 40 cents or 0.4, 40%. Now then add that to our accumulated depreciation. And then now subtract the cost minus that accumulated depreciation, and we're down to that. Now when we get to year 5, we don't have to do the math of it. We want this to end at the salvage value. The salvage value is $30,000. So then this is going to become a plug. So then we say, okay, it is 41,990.4. We want it to be 30,000 when we're all done. So that's going to be what it has to be in order to get that method to work. So again, those are our 3 methods. Straight line is the easiest, and most companies use it, but the other ones are also generally accepted accounting principles, so they could be used. All right, so then now I'll go back up. So this one we have the disposal of assets. So I will have a date because I think they want us to do our journal entries. Then our account, and then the debit, and then the credit. Okay. So the Diaz company owns a machine that costs $250,000 and has accumulated depreciation of $182,000. Prepare the journal entry to record the disposal of the machine on January 1st in each separate situation. So one, the machine needed extensive repairs and is not worth repairing. That is, dispose of the machine with nothing in return. So I guess, to be honest, we don't have a date in this one. So if they dispose it for nothing in return, we are going to have a loss on the disposal as a debit. We're going to debit accumulated depreciation. Just a little bit shorter. Okay, and then we're going to credit the equipment or the machine. So then the machine is $250,000 as our historical cost. The accumulated depreciation is $182,000. So then what do I need to make this entry balance? I need another debit. So $250,000 minus the $182,000. $68,000 is my book value on that day. So that whole thing would be, a write-off. Then we come down here and we're going to say, okay, we receive cash. So cash of $35,000. We still are going to have the same, sorry, the wrong column. We're still going to have the same accounts here because if we get $35,000 is less than the $68,000 book value. So then we know that we're going to have a loss on the disposal. So I'm going to go ahead and copy those down and put them down in here. But my loss will be a different number. So I still have to get rid of the machine at $250,000. I still have to get rid of the accumulated depreciation at $182,000. But then now my difference between the $35,000 and the $68,000 is going to be my loss. And again, you can always double check that those equal, that our journal entries in balance, but it is. Now then, what if we sold it $68,000 equals our $68,000 book value? Then we're not going to receive, or we are going to receive cash. Sorry, we're not going to have any loss. So 68,000 is going to be our cash that we receive, and then our final two accounts are going to be the same. So these ones, again, never change. So we're always debiting accumulated depreciation for the 182 and then crediting the machine. Let me add a couple rows here. Okay. Then the last one now, what if we sell it for $80,000 cash? And that is more than our $68,000. So then now we're going to have a gain. So cash is going to come in for the $68,000. I'm still going to have these same two entries because, again, those are always going to be, doesn't matter. But then now I'm going to have a gain on the disposal. And then my gain is going to be the $80,000 minus the $68,000 book value. And again, what you need to make that balance. Did that really balance though? I'm sorry, I didn't change this. So cash comes in at $80,000. We get rid of the machine and the accumulated depreciation, and then we record the gain. Okay, then we come down to our next one, depletion of our natural resources. Montana Mining pays $3,721,000 for an ore deposit containing 1,525,000 tons. The company installs machinery in the mine costing $213,500. Both of the ore and the machinery will have no salvage value after the ore is completely mined. Montana mines and sells 166,200 tons of ore during the year. Prepare the journal entries to record both the ore depletion and the mining machinery depletion. The mining machinery depletion is in proportion. So what that's telling us is it's going to end up being that units of production. So for the depletion, we are going to take the 3,621,000, and then we're going to divide it by 1,525,000 tons. So the cost divided by the units gives us a rate of $2.44 per ton. For our depreciation, we're going to take the cost of the machinery, which is $213,500, no salvage value, so nothing to subtract, and we're going to divide that by the 1,525,000 tons. So to that, divided by that, 14 cents per ton. So then if we then come over here and say how many tons, they mined and sold 166,200 tons. So then now we can take the rate per ton times the number of tons, and that gives us our depletion, and then the same thing with the depreciation. So that times our number of tons, and that's our depreciation. So then our journal entry would be to debit. So again, let's say it's the end of the year. We're going to debit depletion expense, and then we're going to credit accumulated depletion. Just make this go a little bit bigger there. And so again, our debit and our credit, so our debit to depletion expense is $405,528. And then our credit to accumulated depreciation is $405,528. And then we would do the same thing for depletion. We would depreciation, we would debit depreciation expense, and then we would credit accumulated depreciation for those amounts, for the 23,268, 23,268. Okay, so again, that is our depletion. Then preparing a balance sheet, so they give us a suggested trial balance, prepare our classified balance sheet, again, because now we have a few more assets in here. So we would have our current assets as a header, and then in those current assets, we're going to have cash at 6,000. We are going to have, I think that's it, right? So that would be our total current assets. Then we would have our property, plant, and equipment. And we have equipment. Of 20,000 less accumulated depreciation of that equipment of 13,000, and then we would have, and we can subtotal those over here. Then we would have a silver mine. And our silver mine is 45,000, less the accumulated depletion of that silver mine is 3,000, and then we would carry that total over. Okay, and then those would total our plant assets. I don't see anything else, right? Silver mine and equipment. Okay, then we come down to intangible assets. and we would have the patent at 4,000 less accumulated amortization of that patent. Whoops, I left a 0 out of there. I'll go back up. And then we would also have goodwill. And our goodwill is 5,000. And then we would total those up. For our total intangible assets. And then we'd come down and have our total assets, which would be the cash or the current assets, property, plant, and equipment, and then those intangible assets. And then we'd come over to the other side for our current liabilities. And we have accounts payable. And the accounts payable was 2,000, is that true? Yep, 2,000. And I think that is our only current one because the notes payable are 9 years. So then we'll come down to our long-term. And the notes payable, again, are 11,000. And then we would total those long-term liabilities. And then we would total our liabilities. Then we would have our equity. So common stock, 10,000. Retained earnings of 40,000. And I think that's everything. And so we would total our equity. And then we would have our total liabilities and equity. And then our balance sheet balances. So again, I think the real point of this one is to just show you all the different long-term assets then and how they're kind of grouped. And they're always shown less of their either depreciation, depletion, or amortization. Okay, then our last one for this chapter is our asset turnover. So our asset turnover is our sales divided by our average total assets. So in this case, we'll just do the 1 year. So we'll just do year 2. So our sales for year 2 are 1,800,000. And then our average total assets, we need to average those. So our oh wait, shoot, that was not my sales budget. That was my total assets. All right, so go back up. My sales for year 2 is 5,856,480. My average total assets are what I was pulling in there. So year 1 is 1,686,000 plus 1,800,000 for year 2. And then we want to average those together. So add them together and divide by 2. So that is going to be our average. And then we're going to take our sales and divide it by that average. And that is our turnover ratio. So we would say it turns over 3.36 times. The more it turns over, the better. Okay. Then Chapter 9, we only have a couple. It was on our current liabilities. So we've got Keisha Company borrows $200,000 cash on November 1st of the current year by signing a 90-day 9% $200,000 note. On what date does that note mature? So again, we're going to use our second menu and our 1, which takes us into that date function. And then you're going to put in to date 1, the first field is going to be the issue date. So 11.0125. Then we're going to arrow down to our days between our dates. And our days between our dates are going to be 90. And then we're going to arrow back up to date 2. And then we're going to compute. So if I do that on my calculator, again, second menu, number 1, 11.0125, push enter, arrow down twice to get to the days between the dates, 90, push enter, arrow back up to date 2, and then push compute. So it's going to be due on January 30th of 2026. And then how much interest is recorded in our current year. So again, our formula is our principal times our rate times our time. And we are at November 1st. So then our formula is going to be the $200,000 times the 9% times, there'd be 61 days. So 30 days in November, 31 days in December. So 61 divided by 360. So that's our formula. Let me see. Let me go here so you can see it. I'll put in the caret and then I'll copy it down and put it in the equals. So $3,041.55 is going to be the amount of interest that we're going to record. So how did I get a different number? 200,000 times 9% times 61 days. Something's up with my math, I think. Let me try this again. Yeah, so they just want me to use the 60 days. They don't want me to use 61. And then that makes it the 3,000. Now maybe, so why is that math off down there though? When I do it on my oh, I see what I did, sorry. Okay, there we go. Now if we do it in our calculator, let's try that. So if we do the second menu button and the date 1, November 1st to December 31st, and then arrow down and compute, it is only 60 days. So sorry about that. I'm adding an extra day that I shouldn't. So because you don't count the day it starts. So it truly is only 60 days. So my apologies on that one. Okay, so that's how much interest would be recorded in the current year. Then I'm going to do the same thing now, but we are going to do the whole period. So the whole period is 90 days. So if we come to that formula and we take 90 days, that gives us 4,500. So then that's the total. If we've already accrued 3,000 at the end of the year, then the difference is what we are going to show as interest expense. So that would be, so this would be at December 31st. And then this is going to be at January 30th. That would be our interest. So then prepare those journal entries. I think I'll come over here. So our date, our account, the debit and the credit. Okay, so on November 1st, when we issue the note, we are going to receive the cash for $200,000, and then we're going to record the notes payable as a credit for $200,000. Okay, then at the end of the year, we're going to come in and we're going to record interest expense. We haven't paid it yet, but we know we owe it for the $3,000, and then we're going to credit interest payable for the $3,000. Then when the note comes due and we do pay it, which again was on January 30th of 2026, we're going to debit interest expense. We're going to debit that interest payable, and we're going to debit the notes payable, and then we're going to credit cash. So the cash is going to be for the full amount. So the $200,000 plus the $4,500 that we owe total in interest. The note was for $200,000, and then the interest, what we recorded at the end of the year was $3,000, again right above. And then the interest expense is the $1,500 that we just mapped out that we owe. So then we've properly put the interest expense in the month of January. We have properly removed that payable and the notes payable, and then have paid the note in full, principal and interest. Okay, then this next one deals with recording payroll. So we've got sales salaries of $200,000. So they want us to do the journal entry. So I'll go ahead and just kind of set it up. I guess copy these down. And then we'll make sure those are all numbers. Okay. So on July 31st, we have sales, salaries, expense. Then we have office salaries expense. And we'll debit those for the gross amount, so $200,000, $160,000. Then we'll get into our withholding. So we'll have federal income tax payable, and that is $90,000. We'll have state income tax payable, and that is $20,000. We have Social Security tax payable, and that is $22,320. We have Medicare tax payable, $5,220. Medical insurance payable, for $7,000. Life insurance payable for $4,000. Whoops, sorry, wrong column. Union dues of $1,000. And then we're going to put it to our salaries payable. So basically, it's going to be our gross wages minus all of those deductions. So $210,460. Then we would pay it. Then it says we would pay it. I don't know what date. It doesn't give me a date, so let's just say it's August 1st. Then when we pay it, we're going to debit the salaries payable for the $210,460, and then we're going to credit cash because we're paying the workers. Okay. Then it says for number 3, do the accrued employer taxes, assume that the FICA taxes are identical to those of the employees, and that SUTA taxes are 5.4% and FUTA are 0.6% to the employee benefits expense. No, that's not it. So we would just do payroll tax expense. All right, so that's going to be so if we look back up here, our Social Security and our Medicare are the same. So I can copy those and put those down here. Now, it tells us that salaries subject to unemployment taxes are $50,000. So then if we have FUTA tax payable, again, remember the employees don't pay it, only the employer. So if it's 50,000 times 0.006 or 0.6%, whoops, no, that's not a date. We don't want that to be a date. $300. And then if we have SUTA tax payable, let me just make sure those are all dates. So that's going to be the 50,000 subject to unemployment taxes times 0.054, 5.4%. Too much, too many zeros. Okay. So that should be all of their payroll taxes. So then now we would add those together. So the the Social Security plus the Medicare, then plus the FUTA, and then the SUTA. So that would be their payroll tax expense for that period. Then their benefits, it tells us that the employee pays 40% of the medical and the life premiums. So then the employer would pay the 60%. So then that they tell us to call that employee benefits expense. And then it's going to be these two. I'm going to change the amounts, but I'm going to copy them down. So if 7,000 is 40%, if I divide that by 0.40, that would bring me 17,500. Yeah. So then if I take the 4,000 and I divide that by the 0.40, because they're paying the 40%, that's going to be 10,000. So that grosses it up to the total. But then now we want to say that times 0.6. And that times 0.6. So then those would be our total. So 10,500 and then 6,000. So by dividing it by the 40%, I grossed it up to the 100%, and then I took it at 60. So then 16,500 would be the employee benefits expense. And then the final entry, we would just pay all of those off, and we would debit those in credit cash. Okay, then our last chapter, we deal with our bonds. So we have amortizing the bond discount, and then amortizing the bond premium, and then the installment loan. So again, we'll put in our formulas, or sorry, not our formulas, our headers here to do our journal entries. So Hillside issues $4 million of 6% 15-year bonds dated January 1st of 2027 that pay interest semi-annually on June 30th and December 31st. The bonds are issue priced at $3,456,448. So prepare the January 1st journal entry to record the bonds issuance. So cash comes in at the issue price, $3,456,448. we are going to, in this case, because again, the par value, let me skip a little space, go down to the bonds payable, which is going to be a credit of the $4 million. Then because we got less cash than the par value, we have a discount on the bonds. And it's going to be for the difference. So 4 million minus the cash we received, that is our discount. Then when we get to the end of the semi-annual period, which I guess the first one's going to be June 30th, record the cash payment, the straight line discount amortization, and the bond interest expense. So if I come over here, the $453,552 is what I'm trying to amortize out. So they're 15-year bonds and they pay interest semi-annually. So that's going to be 30 interest payments. So that divided by 30 gives us how much we're going to amortize out of that discount. Sorry, my spelling's off again up here. So then our entry, we debit bond interest expense. We are going to credit the discount on the bond because, again, that's what we're trying to amortize it to get it to go away. And then we're going to credit cash because we're paying cash. So I'll come back over here. Our formula is going to be the interest times principal times rate times time. So 4 million times 0.06 times 0.5 or divided by 2. So 120,000 is what it's going to pay in cash. So that's my credit to cash. My discount on the bonds is what we just calculated, the $18,118.40. So then my bond interest expense is those two things added together. So that is our cash payment, amortization of the bond, and then the bond interest expense. Then 3 says what would be the total bond interest recognized over its life. So again, if we do our principal times rate times time for the whole life of the bonds. So we've got 4 million. Here, I'll put it in with the characters. Times the 0.06 times 15 years. And then we'll carry that down. Okay, so 3 million, sorry, 3 million, that can't be right. I think I didn't take my formula correctly, did it? 360,000. Did I put in enough zeros? No. It just seems like that seems like too large. But I guess just the length of time it is correct. Okay, so that is what we're going to pay. Then we're going to have the discount, the $543,552. So that I guess should be our cash. This is going to be our discount. So let's add those two together. And that gives us $4,143,552. If we come down here and we take what we just figured out up here times 30, we get that same answer. So then we kind of backed into how it's calculated. It's the cash payments plus the discount. And then that would be our same entry for all of those for over that bond's life. So that would be number 5. Prepare the journal entry. So that's what we did. And I'm not going to set up the table just for the sake of time because this video is already up to an hour. Okay, then we come down to the amortization of a bond premium. So prepare our journal entry when we issue the bond out. And in this case, instead of selling it at a discount, we're getting it at a premium. So cash comes in for $4,895,980. Now in this case, we're going to have a premium on the bonds, and then we're going to have our bonds payable. So our premium on the bond is the difference, so the $895,980, and then the bonds are still the $4 million. Okay. Then compute the cash payment, the straight line amortization, and the bond interest expense. I think I'll just do it the same way I did up there where I did the journal entry. So again, like just up there. So we've got our bond interest expense. Now in this case, we're going to, when we amortize the premium, we're going to debit it, because when we first set it up, it's a credit, and then we're going to pay cash. Now the cash doesn't change, because again, it's still the $4 million bonds at 6% for 15 years, paying semi-annually. So our payment is still what I've calculated up above there. So the $120,000. Oops. Now what we need to do though is figure out the amortization of that premium. So $895,980, and then we divide that by 30. And that amortization on the premium is going to be $29,866. And then our bond interest expense now in this way goes the other way. So what we pay less the premium, and that's our bond interest expense. And then if I come up here, this part doesn't change. So that part, again, because it's the same problem. So we're still paying $3,600,000 in cash, but then now we're going to subtract our premium. So then that minus, so then that minus that premium gives us $2,704,020. And again, if I come over to double check it and I take the $90,134 that I charged to bond interest expense and I multiply that by 30, I get that same answer. So that I know I've double checked it. And again, this, what I put in here, this would be the journal entry that they would do every semi-annual period for the life of the bonds. Okay. Again, I'll skip the table. Okay, then in our installment note, I use our time value money keys. So we've got our N, our IY, our PV, our PMT, and our FV. So they borrowed $200,000 cash. So that is my present value because they borrow it today. It's a 5-year note, so that's my N. It's 8% interest, no future value on a note, and then I'm going to compute the payment. So if I put those into my calculator, 5 is my N, 8 is my IY, 200,000, make it negative, is my present value, no future value on a loan, so zero that out, and then compute the payment. So we get $50,091. So we've confirmed what they show us there in the problem, so that's correct. Now then I'm going to hit my second menu button and my PV button, which takes me into the amortization function. So second menu, PV, and then I'm going to make my P1 equal to 1 and my P2 equal, to 1. and then I'm going to fill in what it gives me. So the balance, the principal, and the interest. So then after I make that first payment, the balance goes down to $165,909. I'm going to leave the cents off. We go like this. Okay. And then I arrow down again. Out of that first payment, $34,091 comes out in principal. Arrow down again, and $16,000 is in interest. Now then I'm going to do the same thing over here and make my P1 equal to 2, my P2 equal to 2. So push 2, push enter, arrow down, 2, enter, arrow down. My balance goes down to $129,090. Out of the second payment, $36,819 comes out as principal, and then $13,273 is interest. So you could keep doing that over the life. They just want us to do those two so we can do our journal entries. So then our journal entry for the first two payments, again, would be December 31st, and we are going to debit the notes payable for the amount of the principal, so $34,091. We're going to debit interest expense for the $16,000, and then we're going to credit cash for the $50,091. Then the next year, we're going to do the same thing. We're going to debit notes payable, not for the same dollar amount, though. We got to look over at that second column. So $129,090, or no, sorry, that was my balance. $36,819, and then debit interest expense, $16,000, and then credit cash, $50,091. And then that is what you do. So it's very comparable to using our time value money calculations to get to what that payment is on a loan. Then we go into the amortization function to figure out how much goes to interest and how much reduces our principal balance, which reduces that notes payable.